Your neighbor just bought a third vacation home. You can't afford groceries. Welcome to the K-shaped economy. Here's the number that changes everything. In 2026, the top 10% of Americans now hold 93% of all stock market wealth. The bottom 50%? They own less than 1%. This isn't a recession. It's not a recovery either. It's a sorting mechanism. And if you don't understand the trap, you're already inside it. Let's rewind to when the middle class actually existed. Post-World War II America, 1945 to 1975. This was the golden age. Factory jobs paid enough to buy a house. College cost less than a used car. One income supported a family of 4. The wealth distribution looked like a diamond, fat in the middle, small at the extremes. But here's what nobody tells you. That wasn't capitalism's natural state. It was an accident of history. Europe and Asia were rubble. America had the only functional manufacturing base on Earth. We had no competition. Unions had leverage. Corporations needed workers more than workers needed any single corporation. The social contract was simple. You show up, work hard, and the system rewards you with stability. Then the clock started ticking. 1971. Nixon ends the gold standard. Money becomes untethered from physical reality. 1973. Oil crisis. Inflation spikes. The post-war boom coughs blood. 1980s. Reaganomics. Deregulation. Tax cuts for the top. The philosophy shifts from, how do we grow the pie, to how do I get a bigger slice? 1999. Glass-Steagall repealed. The wall between your savings account and Wall Street's casino crumbles. 2008. The banks blow up the economy. They get bailouts. You get foreclosed. And here's the secret nobody wanted you to notice. After every crisis, the recovery was never even. The Federal Reserve's solution to every problem became the same. Lower interest rates. Print money. Flood the system with cheap capital. Sounds good, right? Wrong. That money didn't go to workers. It went to assets. If you owned stocks, real estate, or businesses, you got richer. Exponentially richer. If you sold your labor for a paycheck, you got 2% annual raises, while your rent went up 8% and your health insurance doubled. The K-shape didn't start in 2020. It started the moment we decided to save the economy by making assets more valuable instead of making workers more valuable. By 2019, the trap was already set. Then came the pandemic, and the K-shape went vertical. March 2020, the world locks down. 30 million Americans file for unemployment in 6 weeks. Small businesses shutter. Restaurants go dark. The economy flatlines. The government responds with the largest monetary intervention in human history. $6 trillion. Stimulus checks. Paycheck protection program. Expanded unemployment. The Fed slashes rates to zero and buys everything bonds, mortgage securities, corporate debt. For 3 months, it looked like the system might actually help regular people. Then Wall Street figured out the game. June 2020, the stock market hits all-time highs, while unemployment is still in double digits. How? The money wasn't going to Main Street anymore. It was going to asset prices. If you had capital, you borrowed at near zero interest rates and bought everything. Stocks, bonds, real estate, crypto, vintage cars, art, Pokemon cards. Anything that wasn't nailed down. The first crack appeared in housing. Suburban home prices jumped 15% in 2020, then 18% in 2021. Millennials who'd been saving for years suddenly couldn't compete with cash offers from investors, and remote workers fleeing cities. The wealth gap became a chasm. Remote work saved the professional class. Software engineers, consultants, finance brothers, marketing directors. They kept their 6-figure salaries, moved to cheaper cities, and bought second homes. Meanwhile, Service workers, bartenders, hairdressers, retail clerks, hotel staff got decimated. No Zoom meeting can pour you a beer or cut your hair. By late 2021, two Americas had fully diverged. America 1, working from home. Stock portfolios up 40%. Real estate equity soaring. Disposable income at record highs. America 2, back to in-person work for $15 an hour. Rent up 25%. Childcare costs eating half the paycheck. Savings account empty. Nobody noticed until inflation arrived. Inflation hits 9%. The Fed finally panics and raises interest rates faster than any time since the 1980s. From 0 to 5.5% in 18 months. This was supposed to cool the economy. Slow down spending. Bring prices back to earth. It did the opposite for the K-shape. For the wealthy, higher rates meant better returns on savings and bonds. Their treasury bills and money market funds suddenly paid 5%. Free money for doing nothing. For the middle class, higher rates meant mortgage payments doubled. Car loans became unaffordable. Credit card debt spiraled. The housing market froze. Existing homeowners sat on 3% mortgages from 2020. They couldn't sell without financial suicide. First-time buyers couldn't afford 7% mortgages on inflated prices. The American dream became a locked door. But here's where it gets darker. Corporate America used inflation as cover. They raised prices 20%, while their costs only went up 8%. Profit margins hit record highs. Then they announced layoffs. Tech companies cut 400,000 jobs between 2022 and 2024. Not because they were losing money, because Wall Street rewarded efficiency. Fire workers, stock goes up, CEO gets bonus. The incentive structure was perfectly designed to hollow out the middle. And almost nobody saw the final trap closing. 2026. The middle class didn't collapse overnight. It evaporated gradually, then suddenly. Here's the math that ends the game. Median household income, $78,000. Median home price, $435,000. That's a price-to-income ratio of 5.6 to 1. In 1985, it was 3.2 to 1. In 2000, it was 3.5 to 1. For the first time in American history, the middle class can't afford a middle-class home. But housing is just the surface. The real collapse is happening in liquidity. 62% of Americans live paycheck to paycheck in 2026, including those making six figures. How do you live paycheck to paycheck on $100,000 a year? Watch the math. Take home after taxes, $6,200 per month. Rent in any decent school district, $3,200. Childcare for 2 kids, $1,800. Health insurance, $900. Car payment, $650. Student loans, $580. You're at $7,130. You're already $930 in the red before groceries, gas, or saving a single dollar. The middle class isn't being lazy. They're being mathematically eliminated. Meanwhile, the top 1% are having their best decade ever. Billionaire wealth increased by $2.1 trillion in 2025 alone. The S&P 500 hit 6,800 in January 2026. If you owned $100,000 in index funds in 2020, you now have $280,000. If you were working for $45,000 a year in 2020, you now make $52,000, and everything costs 35% more. The final crack appears in debt. Credit card balances hit $1.3 trillion. Auto loan delinquencies spiked to 2008 levels. Student loan payments resume after 3-year pause. The middle class is now spending 40% of income on debt service. 40%. They're not building wealth. They're servicing the wealth extraction machine. And here's the moment of total failure. The Federal Reserve can't fix this. Raise rates? The middle class drowns in debt costs. Lower rates? Asset prices inflate further out of reach. They've lost control of the distribution mechanism. The economy is growing. Just not for you. This is the K-shaped trap fully closed. Every collapse follows the same pattern. The Codex pattern. 5 phases that repeat across centuries like clockwork. Phase 1. Complacency. The system works. Wealth is flowing. Everyone believes this time is different. 1920s America. Permanent prosperity plateau. 1990s. New economy paradigm. 2020s. Soft landing guaranteed. The fatal mistake is always the same, assuming the rules have changed. They haven't. Phase 2. Excess. When money is cheap and optimism is high, rationality dies. Tulip bulbs in 1630s Amsterdam. Railroad stocks in the 1870s. Dot-com companies with zero revenue in 1999. Subprime mortgage derivatives in 2007. Meme stocks and dog coins in 2021. The excess phase always targets the same victims. People who got locked out during complacency and are desperate to catch up. They're not greedy. They're terrified of being left behind. Phase 3. Warning. Smart money starts moving. Insiders sell. Institutional investors reduce positions. Credit spreads widen, but the warnings are always ignored. 1929. Stock prices have reached a permanently high plateau. Irving Fisher, 9 days before the crash. 2007. Subprime is contained. Ben Bernanke, months before global financial crisis. 2021. Inflation is transitory. Jerome Powell, before 9% inflation. The pattern is perfect. Authority figures reassure the public right before catastrophe. Why? Because they have to. Panic is contagious. Admitting the truth accelerates the collapse. Phase 4. Panic. The moment everyone realizes simultaneously. Bank runs, margin calls, flash crashes, contagion, the stampede for the exit. But here's what makes the K-shaped trap different from previous crashes. In traditional crashes, everyone suffered together, then recovered together. In K-shaped collapses, the top profits from the bottom's pain. 2008. Banks got bailouts. Hedge funds bought foreclosed homes at pennies on the dollar. The wealthy bought stocks at the bottom. 2020. Tech billionaires added $1.8 trillion to their wealth, while small businesses died. The panic phase now redistributes wealth upward. The crisis isn't a bug, it's a feature. Phase 5. Reset. After every collapse comes the reset. New rules, new structures. New winners. But pay attention to who writes those rules. After 1929, Glass-Steagall, Social Security, progressive taxation, workers gained power. After 2008, bank consolidation, quantitative easing, zero accountability. Capital gained power. After 2020, permanent remote work for knowledge workers, gigification for everyone else. The K-shape locked in. The reset phase determines the next 50 years. And in 2026, we're watching the reset happen in real time. The question isn't whether the middle class will survive. It's whether it was ever meant to. That 30-year post-war miracle? An aberration? The K-shape? That's the historical norm. Aristocracy and peasants. Patricians and plebeians. Capital and labor. For most of human history, there was no middle. We're not watching the middle class die. We're watching it return to its natural state, temporary. So where are we in the cycle right now? Let me show you 3 warning signs flashing red in 2026. Warning sign 1. The Magnificent 7 trap. 7 companies now represent 32% of the entire S&P 500's value. The last time concentration was this extreme? 1999, 6 months before the dot-com crash. When everyone owns the same 7 stocks, there's no diversity. Just synchronized risk. One crack and the whole structure falls. Warning sign 2. The private equity landlord. Private equity firms now own 40% of single-family rental homes in major metros. They're not competing with other landlords. They're using algorithm-driven pricing to maximize extraction. Your rent isn't high because of supply and demand anymore. It's high because an algorithm determined that's the maximum you'll pay before you break. And they all use the same software. It's not a market, it's a cartel. Warning sign 3. The subscription economy endgame. Everything is becoming a subscription. Your car features, your heated seats, your software, your entertainment. Average American now pays $924 per month in subscriptions. You don't own anything anymore. You rent your life from corporations, month by month. And the second you miss a payment, access revokes. This is the final form of the K-shaped economy. The top owns everything. The bottom rents everything. The middle? There is no middle. These aren't predictions. They're observations. The trap is already closed. The middle class isn't dying from bad policy. It's dying from perfect execution. Every mechanism, monetary policy, tax structure, corporate consolidation, algorithmic pricing is working exactly as designed. Not to distribute prosperity, to concentrate it. You want to know the scariest part? The next phase isn't human landlords or human bosses. It's automated wealth extraction. AI setting your rent. AI determining your creditworthiness. AI deciding your employment. And algorithms don't negotiate. The question we're investigating next: what happens when artificial intelligence becomes the landlord, the employer, and the bank all at once? Because if you think the K-shape is brutal now, wait until it's automated.